Hey everyone, welcome to the final bar. It's August 30th, 2022. We'll talk about this ongoing sort of bearish move that we've seen, this retrenchment that we've seen from the markets. The S&P down about 1%, same with the NASDAQ. A lot of choppiness going into the close, really the damage done in the first hour of trading. We'll look at that particular sell-off, a continuation of yesterday's move, and then what happens from there. A lot of stocks testing key resistance or key support levels. We'll break them down for you today. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit was designed to help you quantify investor behavior, better appreciate the lessons of market history, and better understand market dynamics. And we'll talk about how the tools of the technical analyst can be applied to this sort of market. I was talking to a CMT colleague of mine earlier in the day. We were talking about the upcoming 50th anniversary of the CMT Association next year, which is a pretty big deal. And we were talking about the history of the organization, just how the craft of technical analysis has evolved. And while it has certainly evolved in dramatic ways in terms of computerization, in terms of automation, all the tools that I can apply as a technical analyst, which 50 years ago we wouldn't have dreamed of, a lot of it is very similar in terms of the consistent application of tried and true rules. It's all about quantifying trends. What's happening? Where is it happening? And how can I anticipate when it's not happening anymore? I think those are the same questions that Ralph Acampora or Alan Shaw or Bob Farrell or others years ago were trying to answer themselves. And so we have a lot of great things we can use to understand the markets. Let's apply them together. Great guest today, Joe Rabil. He's one of the best, does a great job of sort of making sense of things in choppy markets. So I'm interested to hear his take on what's going on here with the recent sell-off. A couple other things to let you know about coming up here. Tomorrow on Wednesday, the 31st, we have Miss Schneider from Market Gauge down in New Mexico. On Thursday, the 1st, Mike Shell of Shell Capital Management joining us for the first time. Next week on Tuesday, the 7th, we have John Kosar of Asbury Research, great macro analyst with some breadth data that I'd love to pick his brain on a little bit. Also, just so you know, we have an event coming up in about 4 to 5 weeks, I think 5 weeks out, ChartCon 2022. If you go to StockCharts.com/ChartCon, we are putting together an incredible group of people. Joe Rabil, today's guest, will be on site here in Redmond, Washington, along with 16 of his close friends, our other commentators, all sort of giving their take on the market. We have a number of really cool panels to share with you and a lot of great expertise. We do a show called The Pitch, and we will do a special live version of The Pitch. We will actually hear all of their pitches live from the studio. You can ask some questions. It's going to be really, really fun. We were actually in the studio earlier today, sort of plotting out how we're going to do some of the different panels. Please attend. It's going to be so much fun. I don't want you to miss out. Go to StockCharts.com/ChartCon. Can't miss that event coming up October 7th and 8th. Let's continue on today's show with our market recap. What we like to do is take a look at how the markets have evolved from yesterday's close to today's close. Let's make sense of today's action, but more importantly, connect it to the longer term trends. What did we learn today about the larger time period? Just to check in on where things finished, the S&P down just over 1%, below 4,000. That is noteworthy because I know it felt to a lot of investors when we broke above 4,000 going up. I heard people saying either explicitly or implicitly, that's the last time we're going to see 4,000. And I feel like we've come right back to there. So, potential downside targets, very much relevant to be thinking about and thinking about your risk profile as the market, or if the market would continue to go lower. No huge difference today from the Dow, S&P, and NASDAQ. A lot of times there's sort of a spread between those, but it was kind of everything down today. It's sort of evened out because the FANG sectors are kind of in the middle of the list today. The VIX continuing to push higher. And one of my favorite charts, I always think during a crazy market like 2022 has definitely been, I'm already putting together my list of charts that at some point I will look back retrospectively and say, These were the charts that told the story of 2022, and 100% I am convinced the VIX is one of those. The VIX bouncing off of 20, the VIX rallying up to the low mid 30s has been one of the best charts to tell you a lot about the dynamics of the market. 10-year interest rate would be a second chart I will definitely put in there. No real change today, to be honest. A lot of choppiness, but still around 311 for the 10-year yield, just above 320 for the long bond yield. The dollar index really not moving too much from yesterday either. A lot of red on the page of commodities, and that's maybe a big difference today than what we've seen in recent days. The fact that the energy sector was actually right at the bottom of the list. It's in recent weeks has been at the top, up 2-3%, while everything else has been sort of, a little bit up, flat to down. And today you have energy moving to the downside. All of the top 8 commodity ETFs that we're tracking here, all in the red. Gold down 0.8%, silver down almost 2%. And oil prices down a good amount. That's what's causing energy to struggle. A bit of a bounce here going into the last couple hours for Ether prices, but pulling back from where we finished yesterday, about when we were getting the show ready. So Ether down about 1.5%, Bitcoin down 2%, back below 20,000. We've often talked about how big round numbers tend to mean things on a lot of charts, but I've certainly seen that with Bitcoin. Go back on the chart of Bitcoin. Just put a horizontal line at 50,000, 40, 20, 30, 10, all of those. You will find that a lot of turns happen of those big round numbers. I don't think that's a coincidence. I think that is where people naturally revisit a thesis. That's where you naturally want to take profits. If you're putting a stop, a lot of times you'll gravitate toward a big round number. And it certainly played out pretty well. Watch 20,000 there for Bitcoin. I want to look briefly at the chart of the S&P 500. My guest today, we're going to start there, so I don't want to address it too deeply, but I would say just from a factual standpoint, the S&P closing below its 50-day moving average today. That is the first time we've closed below the 50-day since back in mid-July. So for the last 6 weeks, we've sort of been above there. That break above the 50-day in July was sort of a signal, because I know at this point we had that first move off the June lows. We sort of had this parallel downtrend channel, and it almost felt like we might just retest the lows and go lower. Breaking above the 50-day was a real indication that we were getting out of that consolidation range, that buyers were taking control, pushing it higher. We broke above the 50-day, tested it from above, and then it was off to the races up to the 200-day. Now we're potentially seeing that flipped over. We've closed below the 50-day. It's all about whether we get confirmation now. Do we, again, sort of retest it from below? It's just below 4,000. First time we've closed below the 4,000 level since mid-late July as well. So a potential pivotal day, maybe confirming the downside in the S&P. Now we'll see what Joe says, and we'll look at some more charts here in a little while. Just to finish up our recap on what happened today, the financial sector, number one. Now, all 11 sectors were down, which I think is worth noting. A lot of times we've had like energy or maybe materials up and everything else, or utilities has done pretty well. Sort of everything struggling today. Financials, the best performer, still down about 50 basis points. It's about 0.5%. On the downside, you had energy down over 3%, followed by materials, real estate, utilities, industrials, all sorted in that 1.5% drawdown. Let us look, if we could, to the Mindful Investor Live chart list, and we'll check on a couple more of these charts. And one of the charts that I've highlighted recently is the high yield spreads. We sort of revisit this randomly just to keep it current. And I think this is important. When I found, when I've worked with institutional investors, which much of my career has been, I have found a lot of times institutional investors are very focused on the credit markets, right? If you're trying to understand a stock, you often look at their debt profile, you look at their debt to equity ratio, you look at their ability to repay the debt that they've raised in their course of growth, their course of operation. And credit spreads can often be a really good indication of what's happening in the bond markets. Because I was taught, when I was learning this whole thing a couple of years ago, I was taught that the fixed income markets tend to lead the equity markets. And the fixed income guys I worked with were very proud of that fact, that don't worry about equities, just look at credit, and that's all you need to know, because it often leads. And I think that's, in general, that has certainly been my experience as an equity-oriented investor, is you gain a lot from looking at the fixed income markets. I found individual investors are a lot less comfortable with fixed income, and as a result, they often avoid it. I think to your own detriment in a year like this. Look at credit spreads, and this is in particular looking at the high yield OAS, and the ticker is kind of confusing, $$ HYIOAS, and all that means is high yield index option adjusted spread. Don't worry about what all of those words mean, that the general summary is this. Number one, I'm plotting this upside down, so don't get too confused. And I'm doing that because then it matches the movements in the S&P. You can see how quickly the data series at the top matches the data series at the bottom. That's the high yield OAS, and that's the S&P at the bottom. If the spreads are widening, that means this line is going down, the values are getting bigger. That means that investors are requiring more premium. They're requiring more from the bond to justify buying it because they're taking on additional risk. So credit spreads tend to widen when conditions are getting worse for these speculative companies. These are essentially junk bonds. These are higher risk equity. So in general, things getting riskier, investors demand more for buying these risky bonds. Obviously, that usually means investors are more risk off or more risk averse, and the equity market's probably going down. When spreads are tightening, meaning the line is going up, the values are getting lower, that usually means the market is rallying. Look what's happened with high yield spreads widening, with the VIX rising off the 20 level. I'm inverting that here as well, because I want the two of those to line up with what I'm seeing with the S&P. In the last week or two, we have now seen a reversal. That those all had been going higher June, July into August. Now you're seeing spreads widen, you're seeing volatility increase, and you're seeing stocks go lower. If I want to get a read on what's happening with equities, the likelihood of going much further, I'm going to be looking at these other two series pretty closely. Let's take a quick commercial break. We'll be back with today's guest, Joe Rabil. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close for our show. A couple quick announcements before we bring on today's guest, Joe Rabil. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show. We'll do another one on Friday of this week. All of these questions have come from viewers like you in the last day or two, so keep them coming. Our email is the best way to send your questions. thefinalbar@stockcharts.com is our email address. We're also on Twitter @FinalBarSCTV. And we're on YouTube. Put a comment below the video you're watching on our Stock Charts YouTube channel. We'll gather all those questions and hope to answer one of yours live on the air on Friday's show. Also, go to StockChartsTV.com. Our on-demand platform is fantastic. Joe Rabil does a show every week, Stock Talk with Joe Rabil. We have a whole great group of contributors, all providing their expertise and their observations through the course of any given trading day. Also, some really cool special events. Larry Williams is going to be doing a special market outlook, I think, in a week and a half. All of that is available for free at StockChartsTV.com or on your mobile device. Just search for Stock Charts TV on demand. I want to welcome on today's guest, Joe Rabil. Joe's the founder of Rabil Stock Research, coming to us from the Mid-Atlantic region. Joe, it's good to see you again. How are you?
Great. How you doing? Nice to be on.
Well. Yeah, no, so it's good to bring you back on, Joe. We've had you on before, obviously, but sort of an interesting environment right now, right? With a lot of uncertainty. I feel like there have been raging bull cases and all of a sudden raging bear cases. Investors are kind of trapped in the middle. We're going to start with your chart of the S&P 500. Walk us through these. What are you seeing?
Right. So I'm one of those guys that I don't like to make major market calls and get pinned down and I never really have like that. But the right now, it's really not a good time to be doing that, in my opinion. And last year was a little different. We had uptrends across the board. If you look, so I have a monthly chart on the left here and a weekly chart on the right. And we can look at last year how both the moving averages on both timeframes were just rising and we were moving up. And then late in the year, we started to lose momentum, but we were still in an uptrend. Now we have, this is why I like to use two timeframes, is I've got the longer term time frame telling me I'm still in an uptrend, but I'm tired. And the smaller time frame, which is a weekly chart, is in a downtrend and trying to turn up. So if I look at the monthly, you can see that we started the year kind of overbought, and then we worked our way down, and now we came down and bounced off the 40-month. That blue line is the 40-month moving average. People ask why I use a 40 instead of a 50, and just quickly I'll say the reason is that I like how it converts to other important lines. So it's the 200 on the next lower time frame. So it's like a 200 week, the 40 month, and then on a weekly chart, the 40 week is a 200 day. Both important lines, but I don't need to have those lines, all those lines up there. I just need these two, and they give me everything I need. So If you see what happened here, we bounced off this 40-month and then rallied up. And what's really disturbing me is the rejection that we got at the 18-month line. When you go back historically, we can see both in 2018 and 2020, we broke that line, came down to the 40. And then when we came back up, we went right back up through. We didn't get rejected. And you go back historically speaking, when you get rejected at this line, it tends not to be a very good situation for the market. So that is highly concerning for me. It's also concerning when we look at the weekly chart, how this is pulling back. It's pulling back pretty hard. I was actually kind of thinking we were going to stay in a trading range for a little bit. And I still think that's the highest probability, but it's certainly testing my resolve here as we're coming down and breaking through the 18-week line.
It's so interesting. When I hear people speculating on what's going to happen next, you hear a lot of vocal, proponents of going up a lot saying going down a lot. You rarely get people talking about a range, but a lot of times that ends up being what actually plays out. So be prepared for that third direction. Now, to switch gears a bit, commodities, right, were, huge story, obviously, in 2021 in the first half of this year. Now pulling back a little bit, what do these charts tell you about the commodity space?
Well, I thought it was worthwhile just to look at this because, the big thing is inflation. Is it, the Fed is trying to control inflation. That's what, anything you read in the financial market, that's what this is all about. And everyone's focusing on rates and really inflation. And I'm sort of looking at this and saying, okay, the CRB is made up, I think, of around 40% energy components and 40% ag components. And this, to me, just looking at these two charts, so this is the same two charts, monthly and weekly, same moving averages. I've got the same MACD, ADX down below. This is a powerful, powerful trend on the monthly chart that got overbought and looks like it's in a digestion phase. This does not look like a topping pattern to me. It looks like something that got ahead of itself and needs to take a breather. And so I think if we're thinking like where the Fed is right now, just looking at this, I think they have some work to do because this doesn't look like the end of the run to me when I go through and look at this. And on the right side, I did highlight the fact that the MACD has come down dramatically and made a lower low, and price is making a significantly higher low. So I drew those two lines showing that's what I call that hidden divergence or reverse divergence, where we've really worked off a pretty significant portion of the oversold condition, but it's really not backing off from a price standpoint. So in the short term, I'm not trying to say that you should go buy all the commodity stocks, but I will say that because we're coming into a declining 18-week, we should pull back. We should come back and test the prior low even potentially over the next 2 to 4 weeks, I think. And that might have been the start of that might have taken place today with what happened to energy. But what I'm telling you is if you look at some of these long-term breakouts in stocks like CVX and PXD and CNQ, Canadian Natural Resource, look at the 10, 15-year chart of these. They're massive, massive breakouts. And could they pull back a little bit more? Yeah, I think they could. But I'm more inclined to be thinking that there's a lot more coming there.
We only have about 30 seconds left, Joe, but I did want to ask you a question here on this last set of charts. These charts are so beautiful, and you humble me and remind me how much I need to use ACP way more than I am, because it's a great way of thinking about multiple time frames. How do you reconcile the monthly MACD or PPO being negative, the weekly being positive? And the answer is, what do I do in that environment? What's the quick answer to how do you make sense of that kind of disagreement, I guess?
Well, you've got an overbought monthly chart that's working off an overbought condition with those MACD lines coming down to the zero, like working their way back down to the zero line. And then the opposite took place because we came down so hard on the weekly. We're working off an oversold condition on the weekly chart. This is the epitome of non-confluence in multiple time frames. You have one doing one thing and one doing the other. It's a very difficult environment. You got to be really careful right now.
Joe, it's great to see you. I'm super excited to have you in the office here very soon for ChartCon. So we'll see you then. But until then, stay safe there, and we'll talk to you again soon. All right.
Thanks, Dave.
That's Joe Rabil. Joe's the founder of Rabil Stock Research, also the host of Stock Talk with Joe Rabil. His show is all driven off of Q&A. Make sure you tune in for that one. It's really well done. Joe's fantastic. And really, I love that thinking about multiple timeframes. And it reminds me, I'm making notes as he's talking, that relationship, thinking about the interplay of these different timeframes and even the daily timeframe we didn't even have up here, thinking about how the market moves on multiple timeframes is a real important way of understanding how movements relate at different levels. And I'd encourage you to explore ACP as a really good way to do that. Great take there from Joe Rabil. Let's continue on with today's show, or the Final Bar mailbag. As a reminder, our email is always open, thefinalbar@stockcharts.com. And let's get to question number 1. Dave, why do you use the 40 and 150 week EMA on your weekly chart? Well, of course, we have a guest on who's dropping knowledge on other moving average combinations. So I'm making a note to go and revisit some of Joe's that he's sharing, because I think there's a lot of wisdom there. I tend to use 2 of them. I use on the weekly charts, my default is the 40 and the 150 week, and I'll tell you why. The 40 week, and it's plays to what Joe said, I think, which is really well. I like when moving averages are making sense on different timeframes, right? So the 40 week lines up very well with the 200 day, right? That's sort of the same general thing. So it's a great way to see the 200 day moving average on your weekly charts. I think that's a level that often comes into play, and I like understanding that. The 150 week, boy, this comes from somewhere. Who was it? It was somebody, I want to say it was Carter Worth, who was at Oppenheimer for a number of years. I think he runs his own shop now, but is frequently in financial media. And Carter, when I used to talk with him regularly in my Fidelity days, he often looked at the 150 day. And so we did some work looking at different timeframes. 150 week for me is just a good long-term time frame. I have found more often than not, if you look at the slope of the 150 week moving average, you don't even need to look at the chart. You get a general sense of what's happening. And that's actually a trick, by the way, that Grayson Rose has often reminded me about. You can actually take the price off. There's a way to do that down here. We could say opacity, I guess you say, make it 0. You can actually remove price from the visible area. You can do that on ACP as well. Then you're just looking at moving average comparisons. You want to do a really cool trick with a list of stocks or ETFs, remove the price and just look at some moving average combinations. You'll find some really interesting things that the price, a lot of times, the daily or weekly prices can just be noise in some cases. So that's a good little trick to think about. This next one is a doozy, so go on this ride with me here. It says, could you please discuss the Zweig Double 9? Also, which of these 3 indicators are the most useful and what the indicators are telling us? So thank you for jogging my memory of obscure breadth indicators that I'd not thought about in a very long time. This is a series of indicators that we have called the Zweig Double 9 indicators. If you are interested, the tickers are here at the bottom, and if you just use the keyword search for Zweig, Zweig, you'll find these indicators on here. I'll give you the quick version, and then for the longer version, go to Chart School where we discuss these in detail. Marty Zweig was a famous market strategist. At one point, his comments would dramatically move the market moment to moment. He was that influential on the markets. He wrote a book, Winning on Wall Street, where we talked about what are called 9-to-1 days. And it's sort of like a 90% day, right? 90% of the volume is bullish or 90% of the volume is bearish. Walt Deemer does a great job following those days. I actually highlighted that last day or two. I think one of my 3 and 3 charts was focusing on 90% days. But here's basically what his thought was. You want to look at times where 9-to-1 ratio of up volume to down volume. If so, that's called a 9-to-1 day. And if you have a cluster of those within 3 months, you have multiple observations, then it becomes a double 9 volume signal, I guess is what he would call it. We have 2 indicators that track the double 9 up volume ratio and the double 9 down volume ratio. If it goes down to -8, that basically tells you that has happened once. That's been a 9-to-1 day. If you see it go to -18, that means that's the second observation or multiple observations within, I think it's 3 months, I remember right. So basically what you're seeing, and it's great that you asked about this because you asked about this before the signal actually registered. Just yesterday, 2 days ago, we actually had a 9-to-1 down day where 90% of the volume was negative. If we get another one of those in the next month or two, that would trigger the double 9 down signal. You can see the last cluster of those was in May, going into early June of 2022. Really accentuates the downward breadth. I would use either one or both of these really to think about. It's a different way of thinking about 90% days, big breadth thrusts upwards or downwards. That is as much as I can get into in about 3 minutes, but thank you for the question and for pointing me back to Marty Zweig's book. Hadn't gotten that off the shelf in quite a while, so I enjoyed catching back up on that one. We have a great article, by the way, and some of our commentators have used that. You can see their articles on the articles tab. Next question. I'm trying to chart lots of ratios. If I want to use XLP to SPY in the main box, what's the easiest way to plot all of my charts from my chart list that same way, rather than typing each symbol and then colon SPY in the main box? So I'll translate what I think your question is doing, which is I want to do this ticker versus the S&P 500. If you type a ticker, the colon SPY, that charts the relative ratio, or the ratio basically of one over the other. But you're saying I want to do that for a bunch of charts, and I don't want to have to keep retyping something colon SPY. So this is a tricky one, but you can do it. So here's what you do. So I'm going to create just a really basic chart. I just have like a really plain chart to start with. So here is the trick. What you want to do is basically just bring up the stock, add an indicator called price dash performance. And there you want to just type in the ticker plus the colon SPY. It's going to update this ticker on the left side anytime you bring up a new stock. Then what you want to do is say position it behind the price. That'll kind of put them over each other. And then you can do this, take this down to 0. And there we go. So if you type in a ticker, it should just show you the ratio of that ticker versus the S&P. Now it's going to look like you have a weird thing over here because it's showing you the scale for the series that's not up there anymore. So if you change this, change this to type performance. That should actually make this look pretty good. There we go. So that's how so you have this weird label on here. That's not my favorite, but overall, this will be pretty good. And if you type in any ticker, you'll get the relative ratio only. You could add other indicators below that'll be based on the price itself and not the ratio. So I hope that is what you're looking for. Thank you for making me think about sharp charts a little bit. These have been Dave stretching questions today, but I appreciate them so much. Keep the questions coming. We'll do another mailbag on Friday. We need to wrap today's show though. Go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. Chart number 1 is the S&P 500. I appreciated very much Joe's comments about the S&P, and I 100% agree. I think this is a choppy, confusing environment, and the day-to-day action certainly backs that up. You have upswings and downswings. In the end of the day, I like looking back at previous observations. He had some thoughts about what happened when I think it was on the monthly chart when it repels that advance. I thought it was a great way of describing it. One of the things I was looking at earlier today was when the RSI on the daily S&P chart has become overbought, and then it's pulled back, and then it stopped at 40. That's happened a couple times recently. I could go back further, but I was just looking at about a year and a half, and you can see this happened in November where you became overbought. That means you've gone up a lot. That's fair. You pulled back. The RSI remained right around 40 and then rotated higher. That made a new all-time high. You saw that in July of last year as well. Overbought. We pulled back a little bit. That was a pullback. We didn't get below 40. We rallied. And that is kind of where we're at right now. But the question mark is, are we done? And I think that's the open question, right? If we would stop at 40, this could be yet another sort of buyable dip among many that we've seen. The environment right now is very different than it was in July of last year, November of last year, which is why I'm skeptical we'll get that. I think it's much more likely we start getting further down to 3,900 or maybe below. Julius de Kempener, by the way, one of our other commentators, wrote an article just today using the RRG to talk about S&P 3,900. So check that one out if you have not. Chart number 2 is the McClellan oscillator. I have a lot of different breadth indicators that we looked at. Great questions today on one of the more obscure ones, the Zweig Double 9, but this is a little more commonly used. The McClellan oscillator, $ NYMO. If you look, this got below 0 about a week and a half, 2 weeks ago here in mid-August, and it remains below 0. The general idea is above 0 is bullish, below 0 is bearish, and that is based on exponential averages of the advanced decline data. In general, this remains below 0. This feels, at least in the short term, as more of a risk-off environment, very much continuing to be in that state with today's choppy sell-off move. Finally, charts like Disney. I forget which stock it was yesterday, maybe Domino's Pizza, one of those that we were highlighting, but a lot of stocks that you look at broke above their June high in August, right? So you got above that resistance level. That was impressive. The S&P did the same thing. Now Disney failed to even reach its 200-day and now is testing that breakout level from above. If this market is in a bullish phase and just in a pullback mode, I would hope, or I would expect, that charts like Disney would find support at their previous breakout level and rotate higher. If this fails to hold 112 going through the remainder of this week, I think that increases the likelihood of a potential retest. Folks, that's our show for today. Special thank you to Joe Rabil from Rabil Stock Research joining us from Virginia. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.